Welcome back to another episode of Give Me Some Truth. A lot of the topics that we do are what are called evergreen. They kind of last depending on whether it's this year, next year, 5 years from now. This one is not. This one is timely. The Fed just cut rates. What does that mean? So that's the topic for today. Implications of that. Sil, why don't you kick it off? Help us just understand kind of what happened. Let's do that. What happened last week?
So what happened was that a 12-person committee within the Federal Reserve, a committee composed of all the members of the Board of Governors of the Federal Reserve, plus a few other members, basically decided to lower their target, so what they view as the most appropriate level of interest rate for specifically the federal funds rate. And the federal funds rate is the rate that large banks can borrow and lend to each other in the overnight lending market. So that's in practice, when you see a headline, oh, the Fed just cut rates, that's what's happened in the background. And so we had a Fed funds rate at 5.5%, and it's just been lowered to 5%. And I think that surprised a lot of people because I think it was kind of, there were kind of two schools of thought. Some people thought that we'd get a 25 basis points, so 0.25% rate cut. I think we got a little bit of a surprise in the sense that they delivered a 50 basis points, a 0.5% rate cut. So very bold move, I would say, on the part of the Federal Reserve. So certainly an interesting development.
Okay, we know what happened. Clint, why did that happen?
Well, they're signaling a couple different things. I mean, number one, they're signaling that they're a little bit more comfortable on the inflation numbers that they're seeing. So they raised interest rates at a pretty rapid clip there for a number of years now. And what they're signaling is that, hey, maybe we're not totally waving, the all clear on inflation, but we're saying that we're a little bit more comfortable in where we're at then. And a secondary thing they could be signaling, and that's why we're all trying to read the tea leaves on what a 50 basis point cut means, is are they signaling that economic weakness is here and we need to get in front of things and maybe they should have cut a little sooner? I think there's some discussion points, and we really won't know the answer to this for another probably year or two before we know, did they cut too quickly? Did they not cut fast enough? And how much economic weakness do we actually have today? And so still, you've gotten a little bit more bearish over time. Are you seeing this as more of an economic weakness signal?
I mean, I think I kind of have to.
Is it because you're pot committed on what you've already said, or you can change your view?
I'm not changing my view, but it is kind of interesting. You're right. The context of this rate cut, right? It's a little bit unusual to see a 50 basis point rate cut when the stock market's hovering around all-time highs, when unemployment numbers are still extremely low, and when, all things considered, the U.S. economy is still reasonably healthy, right? So it's a little bit unusual, and you could see it as effectively kind of almost like saying, sorry guys, we overdid it a little bit on the fighting inflation side, and we need to kind of take a step back here and correct some of what we did in the past. And so I think that's the glass half full kind of interpretation of this rate cut, is they took some very bold, meaningful steps in fighting inflation, and they're now so comfortable with it that they feel that they can be equally bold the other way around, lowering interest rates. And if that's all it is, that's great. At the same time, I can't help but think that this also coincides with, some early signs of weakness in what we're seeing on the consumer side. Early signs of weakness in the job market as well. That's been strong for a very, very long time. And I have to think that that factored into the decision. Obviously, they won't advertise it as, oh, we are incredibly worried about the economy, but I think that had to have been a significant factor in the decision.
Yeah, and I think that it's important also for listeners and viewers to understand that when the Fed lowers rates, they're not immediately lowering mortgage rates, auto loan rates, CD rates, right? Those rates will move as a byproduct of what the Fed has done, but it's not a lockstep move. And in a lot of cases, those rates will move before the Fed actually moves rates themselves, right? So they'll kind of front run that and anticipate what's going to happen. So that's partially the reason why you don't see, kind of more of the everyday consumer rates, if you will, drop 0.5% the morning after the Fed made the move they made.
That's right. So, and interestingly, what we saw last week was an increase in like the 10-year, for example. So when the Federal Reserve cuts interest rates, that really affects the very short-term lending markets. So that affects very, very short-term loans in a very direct way. But products like mortgages that are, long-dated loans, 10, 15, 30 years, those rates are market rates, right? So they're affected by, what traders are doing,
Yep.
What investors in the bond market are doing, much more so than what the Federal Reserve does. And actually, when you see something like, a situation like we have now, when the Federal Reserve cuts interest rates and then long-term rates actually go up, maybe that's an indication that the market thinks cutting rates now may actually have an impact on inflation and growth in the long term. So kind of an interesting development.
Yeah. Clint, what do we think in terms of between now and the end of the year and then into the first half of 2025? Does the Fed hold tight or does the Fed make moves beyond this?
I think they're signaling that they're going to do it in a measured fashion. I don't think we're going to see something as big as 50 basis points unless economic conditions deteriorate significantly. I think you're going to kind of stair step down, and that's what the Fed really laid out in their minutes. They kind of laid out a case for a slow descent in interest rates, a more normalization. But also, I don't feel like we're going to see them cut all the way to 1% or something like that.
Right.
They're still going to leave those rates, I would say, more normalized than historically abnormal, which is what we saw for a really long time.
Right.
We saw historically abnormal rates. And so unless we see something totally unforeseen, I think they'll kind of ease off. And they're going to have to see the inflation data here, too. I think the biggest risk to the Fed is, okay, we've kind of controlled inflation. Everything's all good now. We're going to start cutting rates. And then all of a sudden inflation perks back up.
Yeah.
And I think that would be a real warning signal to them, because if it starts getting away from them, that's the biggest risk. I'm sure that's the keep them up at night sort of situation. And so Michelle Bowman was a dissenter. She was a Fed governor, one of the first dissenters since 2005 on these big rate cuts. And she basically said, I wanted to see a more measured rollout to these rate cuts. So That's a big, and the risk is there that they, didn't do it, slow enough, and then all of a sudden inflation perks back up. So that would be the biggest risk that I see. And, but it's healthy, though, that the rates do come down and our yield curve comes back and we get to a more normalized instead of inverted yield curve. That's usually, that's a better sign, at least. Though I would say in many rate cut situations, we do enter recession. So there is a recession indicator, and the Fed is signaling that we're bringing down interest rates. And the second part of what I said is that there is a risk here that we see an inflation, that we see a recession that occurs as not as a result of the cuts, but as a result of weakening economic conditions. And they're trying to soften that sort of potentially recessionary winds that are blowing right now.
Yeah, I think one topic and one phrase, if you will, one word that gets bantered about at times like this is deflation, right? So help people understand deflation. What does it mean? What is the impact? Why is it so bad?
Well, so there's kind of disinflation and deflation. So yeah, I mean, deflation is not necessarily bad, right? I mean, all things considered, I think deflation is it's almost a good thing, right? You don't want prices to just keep going up eternally. We're not there yet. We're not in a deflationary type environment. What we're seeing now is an environment where prices are continuing to go up, but at a lower pace.
Sure.
Right. And that's ultimately the goal. Is you want to see, the Fed has a target of 2% inflation. So they're not trying to get prices to come down. They're trying to get prices to increase at a rate that is very measured.
Sure.
And that's their goal, and that's their mandate. And they have actually a dual mandate, which is to control inflationary pressure and keep price increases under control, and also full employment, right? Foster a type of economic activity that allows for full employment.
Yeah, I think that's an interesting point too, because I don't think people fully understand the job of the Fed. I think people think that it's much more broad, and the depth and breadth of it is much wider than what it actually is. To your point, they have two mandates, and that is to keep inflation in a measured space, and then also kind of keep an eye on the employment market and try to influence that as much as possible. The Fed's job is not to boost the economy. It's not to keep the stock market high. It's not to avoid recession.
You're exactly right.
Which is so interesting, right? Because if you look at the actual, they're held to these two mandates. Whether they branch out beyond that,
you're right. I mean, their mandate is actually very narrow, right? And actually, the current mandate that has this employment component is a bit broader than what the role of the Fed may have been historically.
Sure.
If I wanted to be cynical. Can I be cynical?
Please do. Couldn't welcome it more.
Some might say that, in some ways, supporting stock valuations has almost become a sort of, unspoken, unofficial part of the Fed's mandate.
De facto.
As they try to, keep the economy going. Because ultimately, if you think about full employment, that's a consequence of a strong economy.
Right.
Right. So it's like the Fed cannot make companies hire people. So once you introduce this, employment component in the mandate of the Federal Reserve, then really its role becomes a lot broader, and it's a lot about supporting the economy. And there's a lot of different aspects to that. And, it could be the cost of capital. It could be, growth. And some might say that on some level, stock valuations contribute to that. But it is true that it's not part of their official mandate, and they should be completely independent. They should not care whether the market goes up or down. In theory, that is entirely accurate. In practice, I think there's a bit more nuance.
Yeah, and what's interesting about it is the inflation mandate is a kind of very one-for-one relationship in a way, right? They can influence rates, which then has a direct influence to inflation. The employment component is a much more subjective. Yeah. There's a lot of variability to it, and so they can't just do something and making unemployment go up or down.
Right.
And so that's an interesting part of it, but. As we wrap up, I think just trying to understand kind of what motivates the Fed moving forward. Clint, help us to understand what might the Fed be looking at in the next 6 months? What are the kind of the key indicators that they're going to focus on to say, do we leave rates where they're at? Do we raise them a quarter? Do we lower them a quarter? And I think that's the other point too people don't quite understand is that they typically move in quarters, right? So the moves that they made this time was kind of a 2-click, if you will, move. they're not going to move it 30 basis points, right? It's going to be 25, 50, 75, 100 generally. So
Generally, yeah.
they decided to make a 2-click move. What are they going to look at here in the next 6 months to determine, the moves that they make, when they meet?
Yeah, I mean, they look at a lot of different benchmarks there. I mean, they do look at the two that we just referenced, but then they'll also look at manufacturing. They'll look at home starts. They'll look at a whole bunch of different, they'll look at port shipments and all kinds of different things to kind of get under the hood and see, are economic conditions weakening or are they strengthening? And that shows up in so many different data points in there. And there's a lot of lag with a lot of them, and a lot of them they can look at more current things. So the Fed will look at all of those different things before they make another decision there. And, I do think they'll kind of step down, because to pause now would indicate that they kind of made a mistake already. So I think you'll probably see a series of a few rate cuts before they would reverse course or pause, because you have to believe that they're fairly convicted in where they stand today. So, you'll see a number of different rate cuts coming up here in the next 6 months. And then I think at that point, they'll kind of take a look at the landscape and see where we're all at.
Yeah. I think there's a lot more to be told to the story than where we're at today, but we'll have to save that topic for another episode of Give Me Some Truth.
Walkner Condon Financial Advisors is a registered investment advisor with the SEC. Registration with the SEC does not imply a certain level of skill or training. The opinions expressed by the participants of this podcast are their own and do not reflect the opinions of Walkner Condon Financial Advisors. All statements and opinions expressed are based upon information considered reliable, although it should not be relied upon as such. Any statements or opinions are subject to change without notice. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk and, unless otherwise stated, are not guaranteed. Information expressed does not take into account your specific situation or objectives and is not intended as recommendations appropriate for any individual. Listeners are encouraged to seek advice from a qualified tax, legal, or investment advisor to determine whether any information presented may be suitable for their specific situation. Past performance is not indicative of future performance. Thanks for listening, and for further information, please visit WalknerCondon.com.